The Reserve Bank of India cut the repo rate by 25 basis points to 6.25% today. This marked the first rate reduction since May 2020. This was also the first monetary policy review under Governor Sanjay Malhotra, who took office as the 26th RBI governor last December. The RBI rate cut comes amidst an economic slowdown and persistently high inflation, which remains above the RBI's 4% target. According to the latest government estimate, India's economy is projected to grow at a 4-year low of 6.4% in the current fiscal year, significantly lower than the 8.2% recorded in FY 2024. Analysts anticipate that economic growth in the coming years will also likely remain below the 8% average of the past 3 years. India's annual consumer inflation rate, or CPI, eased to 5.2% in December from 5.38% in the previous month. Though there is a downward trend, the CPI has overall remained above the RBI's 4% target rate since October 2019. The Monetary Policy Committee, or MPC, which decides the key interest rate for India under the RBI, has chosen to keep the policy neutral. This means the RBI is not in favor of immediately increasing or decreasing interest rates. Instead, it will closely monitor factors like inflation, economic growth, global events, and financial stability before making any future decisions. A neutral stance is usually taken when inflation is still above the RBI's target but is gradually coming down while economic growth is slowing down. By staying neutral, the RBI can maintain a balance between controlling inflation and supporting economic growth. What is the repo rate and how does it affect you? The repo rate is the interest rate at which the RBI lends money to banks when they need funds. This directly affects the cost of loans for businesses and individuals. If the repo rate goes up, banks have to pay more to borrow from RBI. They in turn increase interest rates for customers. Borrowing becomes costlier, and people and businesses spend less, which reduces inflation. If the repo rate goes down, banks get funds at a cheaper rate, loan interest rates fall, borrowing becomes cheaper, people and businesses spend more, which boosts the economy but may also increase inflation. Impact on home loan borrowers due to lower repo rate. Since October 2019, all floating rate retained loans are linked to an external benchmark, which is usually the repo rate. When RBI reduces the repo rate, banks also lower home loan rate, that is the interest rates for homes. This means home loan EMIs will decrease, reducing the financial burden on homeowners. Since most home loans in India have a floating interest rate, a repo rate cut directly benefits home buyers, making housing loans more affordable. Impact on businesses and stock markets. Lower repo rates encourage businesses to take loans at a lower cost. This leads to more investment and expansion, and this is expected to boost economic growth. Stock markets generally tend to rise when the repo rate is cut. This is because businesses pay lower interest on loans, and this pushes up profits, and that in turn attracts investors. To conclude, the RBI's repo rate cut aims to support growth while managing inflation and a slowing GDP. A neutral stance ensures flexibility in policy decisions, balancing inflation control and economic momentum. The cut lowers EMIs, boosts business investments, and improves market sentiment, though RBI will continue to monitor conditions before taking further action.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.